The largest financial market in the world is not the stock exchange, but Forex. Trailing billions of dollars daily, this market is a machine of opportunities. Why are so many people venturing into Forex, and how are they transforming their lives with it? Let's unravel these mysteries and uncover the secrets that move trillions of dollars around the globe. Currency pairs, pips, and lots may seem like technical terms, but they are the basis for success in Forex. How can these simple concepts open doors to a world of financial possibilities? Mastering these essential notions is the first step to navigating this market. And most intriguingly, why do these small details have such a huge impact on your operations? Choosing the right broker can make or break your success. Have you ever thought about how crucial it is to check the reputation and trading conditions before you start? Without this knowledge, you may be at the mercy of scams and false promises. Want to know how to identify the perfect broker and ensure your money is safe while you explore the fascinating world of Forex? Quick introduction to Forex: what it is and how it works. Have you ever wondered how large international companies and banks move billions of dollars every day? This is the world of Forex, the foreign exchange market where currencies are bought and sold at breakneck speed. Forex, or foreign exchange, is the largest financial market in the world, surpassing the sum of the stock and futures markets in terms of transaction volume. Here, you're not just investing, you're participating in a global dance of money. Imagine being able to trade currencies from different countries without leaving your computer. That's Forex. In this market, you buy one currency while selling another, always in pairs. For example, if you believe that the US dollar will appreciate against the euro, you would buy USD/EUR. This pair dynamic allows for incredible flexibility and profit opportunities in whichever direction the market moves. With a daily trading volume in the trillions of dollars, Forex offers liquidity that no other market can match. But how exactly does Forex work? Forex trading is conducted in a decentralized system, where there is no centralized exchange like the New York Stock Exchange. Transactions take place over the counter, OTC, that is, directly between participants such as banks, financial institutions, brokers, and individual investors. This decentralization brings enormous flexibility and accessibility, allowing anyone with an internet connection to participate in the market. It's a world of opportunities waiting to be explored. Main terms and concepts: pip, lots, currency pairs. Understanding Forex terminology can seem intimidating, but mastering these concepts is the first step to becoming a successful trader. Let's start with the basics. What is a pip? Pip stands for point in percentage and represents the smallest price change that a currency pair can have. For most currency pairs, 1 pip is equal to 0.1, which may seem insignificant, but in a market with such volatility, every pip counts. Another crucial term is batch. In Forex, a lot is the unit of measurement for amounts of currencies. There are 3 batch sizes: standard, mini, and micro. A standard lot represents 100,000 units of the base currency. A mini lot represents 10,000 units, and a micro lot represents 1,000 units. Choosing the right lot size for your trades is vital for managing your risk and profit potential. Understanding how lots work helps you better plan your trading strategies and protect your capital. Finally, currency pairs. In Forex, you always trade currency pairs such as EUR/USD or GBP/JPY. The first currency in the pair is called the base currency, and the second is the quote currency. The price of a currency pair represents how much of the quoted currency is needed to buy 1 unit of the base currency. For example, if the EUR/USD pair is quoted at 1,2000, it means that €1 is worth $1.20. Understanding this dynamic is key to interpreting price charts and making informed decisions. Types of analysis: fundamental and technical. In the world of Forex, analysis is the key to making informed decisions. There are 2 main types of analysis: fundamental and technical. Fundamental analysis focuses on macroeconomic factors that can influence currency values. This includes interest rates, economic indicators, geopolitical news, and monetary policies. For example, if the Federal Reserve raises interest rates, it could lead to an appreciation of the US dollar. Fundamental analysis allows you to predict long-term movements based on global economic trends. Technical analysis, on the other hand, focuses on historical price patterns and charts to predict future movements. Using tools such as moving averages, trend lines, and momentum indicators, traders try to identify repeating patterns. Technical analysis is especially useful for identifying entry and exit points in short-term trades. A technical trader may, for example, use a candlestick chart to identify a head and shoulders formation, suggesting a potential trend reversal. Combining fundamental and technical analysis can provide a more complete picture of the market. While fundamental analysis can indicate the overall direction of a currency, technical analysis can help refine the timing of trades. This dual approach offers a competitive advantage, allowing traders to react quickly to changes in the market while maintaining a long-term view. By mastering both types of analysis, you can navigate the Forex market with more confidence and accuracy. How to choose a reliable broker. Choosing the right broker can be the difference between success and failure in Forex. With so many options available, it's crucial to know what to look for. First, check if the broker is regulated by a reputable financial authority, such as the Commodity Futures Trading Commission, CFTC, in the United States, or the Financial Conduct Authority, FCA, in the United Kingdom. The regulation ensures that the broker follows fair and transparent practices, protecting your investment. Another important factor is the quality of the trading platform offered by the broker. A good platform should be intuitive, stable, and offer all the necessary tools for technical analysis and trade execution. MetaTrader 4 and 5 are popular examples of platforms that meet these criteria. Also, check if the broker offers a demo account. This is a great way to test out the platform and its strategies without risking real money. Finally, consider the trading conditions offered by the broker. This includes spreads, commissions, leverage, and customer support. Low spreads and transparent commissions can significantly increase your profits. Leverage gives you the opportunity to amplify your gains, but it also increases risk. So choose a level that matches your risk profile. And don't underestimate the importance of customer support. A good broker should offer 24/7 support, with quick and efficient responses to your questions and problems. Tips for beginners. Avoid common mistakes. Getting started in Forex can be exciting, but it's also fraught with pitfalls that can be costly. One of the most common mistakes is trading without a plan. Without a clear strategy, it's easy to let emotions take over and make impulsive decisions. Create a detailed trading plan, which includes profit targets, risk levels, and rules for entering and exiting trades. Staying disciplined and sticking to your plan can make all the difference in the long run. Another frequent mistake is not properly managing risk. Many beginners are attracted to leverage, which can amplify gains but also losses. Use leverage with caution and never risk more than you can afford to lose. Set stop-loss orders to limit your losses and protect your profits with take-profit orders. Managing risk effectively is critical to the sustainability of your Forex career. Finally, underestimating the importance of continuous learning is a mistake that can be fatal. The Forex market is constantly evolving, and what works today may not work tomorrow. Invest in your education, attend webinars, read books, and follow economic news. Practice with demo accounts until you feel confident, and even after you start trading with real money, keep honing your skills and knowledge. Remember, in Forex, knowledge is power. The world of Forex is full of opportunities, but also of pitfalls for the unwary. How to turn knowledge into power and avoid the mistakes that cost many beginners dearly? The answer lies in deeply understanding the essential concepts and applying smart strategies. Think of the possibilities that open up when mastering Forex. Trading currencies 24 hours a day, taking advantage of market volatility, and turning every pip into profit. Why do so many traders fail to ignore these ground rules? The secret is in preparation and choosing the right tools. And now, with all this information, what will be your next step? Choosing the right broker, practicing with demo accounts, or perhaps diving headfirst into technical and fundamental analysis. The decision is yours, but remember, the Forex market is dynamic and waits for those who are ready to act. What will you do next to secure your place in this vast and lucrative market?